All right, looks like we are live. Having a little bit of problems there with the software. Hopefully in the next month or so, be able to upgrade and get a new laptop. A nice new laptop, not a cheap one, like a really good one. Things are looking that good. So anyway, let's talk about the oil market. There is, of course, the comments from the chairman of Tyson Foods. I'll save that for another show. That'll be extensive. Also, I spoke to Dimitri Kofinas for Hidden Forces podcast, and he says he's going to be interviewing an expert about that. We'll save that for another show again. So today, the oil market, the volatility in the oil market, another crash in the oil market and oil futures. The volatility is tremendous. Good for traders, bad for investors, unless you're investing in these oil tanker stocks. So shout out to Chris McIntosh and Cuppy. They killed that trade. I don't know how long that trade is going to last, but it's done very, very well for them, the oil tanker super contango. I'm looking at companies like TK, which is symbol TK, and I was looking through their financials. I did an article on this for Patreon account contributors, a short one, maybe 3 weeks ago, and I was looking through their financials, and TK Corporation was absolutely horrible. The financials, they haven't made a profit in 4 years. The financials were abysmal, and yet the stock has basically doubled since March 20th. At March 20th, TK was at $2.20 a share. Today it is at $4.19 a share, up almost 10% for the day. So this is a really good short-term trade. Maybe these things will crash. I'll have to see more data on Q1 for the Q1 earnings announcements to see if management is actually at these oil tankers is actually squandering the increasing in lease rates. We'll have to get more information and check. I haven't seen any earnings come out from the oil tanker stocks yet. I've been waiting for those. ExxonMobil is supposed to, speaking of earnings, ExxonMobil is supposed to announce earnings in the next couple days. Looks like as of right now, they're supposed to announce on May 1st. They have had 12 earnings per share downward revisions by analysts trying to help out the company in the last 90 days, according to Seeking Alpha here. And their dividend payout ratio, let me just click. You can go to Seeking Alpha and click on the dividends tab. Their dividend payout ratio now is a more reasonable 103.62%. However, it looks like I found this really good Seeking Alpha article last week with a lot of cash flow projections. I talked about it in an article for Patreon account contributors only a few days ago. It looks like ExxonMobil may be, for full year 2020, minus 25 billion negative cash flow. If that number holds, it's going to be a mess. They're going to have to borrow many, many billions to maintain their dividend. And that's what companies like Chevron and ExxonMobil care about for a bunch of different reasons. The management teams all want to get their bonuses. They don't want pension funds and mutual fund dividend stock mutual funds dumping the shares. So I read some really good research out last week on Seeking Alpha. I talked about it in a Patreon account article a couple days ago about ExxonMobil and Chevron. Looks like both of those companies may have to borrow many billions of dollars to maintain the dividend. We'll see if they cut it or not. But I think an overarching theme for the oil industry now, if you're looking for dividend income, is to not rely on dividend income for any oil company. Now, I know there are a lot of pipeline companies and the master limited partnership companies like Energy Transfer Partners and Enterprise Products Partners, and I'm seeing all these articles on Seeking Alpha that this is the best yield of a lifetime, the best income that people are ever going to get in these stocks. I would issue a lot of caution. Nothing is guaranteed right now because we do not know how much lower oil prices are going to go. We are seeing a lot of hedge fund managers. I spoke to Tavi Costa, hedge fund manager Tavi Costa, about this after I did my interview, that a lot of hedge fund managers are now shorting all different parts of the oil futures curve. So not only is the front month being shorted incredibly, but you have a lot of hedge fund managers like Kyle Bass has disclosed this publicly and others shorting other parts of the oil futures curve, because the oil futures curve, I think only a couple weeks ago, oil companies could sell their oil production in August, September, and I think October for over $30 a barrel. So some of the smarter oil producers like EOG Resources, and it's not the time, in my opinion, it's not the time to buy shares of EOG Resources. They are extremely well run though. And the management team over a month ago saw that things could get a lot worse at EOG Resources. So they locked in, they sold a bunch of their oil production. I don't know exactly how long, I haven't looked at it, but they sold a bunch of it because the press release came out at the beginning of April at $30 or more a barrel. So they locked it in because they were worried that oil prices could crash even more. And that super contango, where the oil price on the futures curve was upward sloping, and August, September, October, the oil prices were still a lot higher than they are right now. They figured that that might come down, that the hedge funds might start to short more of it to knock the future oil prices down even more. So overall, a lot of the oil companies are not doing a good job. You have companies like Occidental Petroleum, and there's been a lot of documentation articles about this. Tracy Schuchart, who's a professional oil trader, she's known as Shy Girl on Twitter. If you trade the oil market or invest in the oil market, you probably want to follow her on Twitter. She's talked extensively about the hedge books being bad for a lot of these oil companies. So instead of just buying puts on the oil price a number of months ago before the oil price started to crash, what these oil company executives, they got overconfident and they started doing these really sophisticated options trade called like cashless collars and three-way collars. And so they made these sophisticated options trades where if the oil price actually went below $40 or $45 a barrel, the oil company was screwed. So a lot of these oil companies, and then you also have oil companies that didn't hedge at all. So you have a lot of exploration and production oil companies that either hedged, have a really bad hedge book, like Occidental Petroleum. They did way too sophisticated options trades, making bets that the oil price would not go below $45, $40, $50, $55 a barrel. So now they're losing money on their hedge book. Or you have companies that are totally unhedged that didn't lock in any of their oil production at a higher oil price. Now those companies that are unhedged, they better work they better not have too much debt on the balance sheet. They better not be overpaying dividends, and they better work really, really hard cutting costs very, very quickly. Some of these companies are actually really good at that. So ConocoPhillips has a good history of being able to cut oil production costs. I've had Robert Rapier on, oil expert. He was my oil mentor, and I worked with him for a while. He did work at ConocoPhillips, so he has a lot of experience with how the company is run. So that company does not hedge, but they are very good at being able to cut costs. So like ExxonMobil and Chevron, I believe, are totally unhedged. The problem with ExxonMobil now, and I think we'll see this in the earnings, we'll see though, is that a lot of ExxonMobil's businesses, so ExxonMobil is a integrated super major, so they have, not only do they produce oil and natural gas, but they also do oil refining. They own refineries, and oil refineries are not making any money. They're cutting back production and offering discounts. And I just saw ExxonMobil, I just saw a story come out a couple days ago. It's here on the Seeking Alpha page for stories from Friday, April 24th, that ExxonMobil has modified their Louisiana refinery facilities to make hand sanitizer. Oh, you can't make this stuff up now. It's so ridiculous. And then also ExxonMobil's midstream and petrochemicals business, I don't think are going to be working that well because, I mean, the global economy is not functioning normally. And those petrochemicals, those plastics that ExxonMobil might make part of, normally they would send those right to China. So then China would start making some molded injections, some plastic molded injections, and then make stuff that goes on container ships to Walmart or some of the Target big box stores. So I think ExxonMobil, a lot of their business, we're going to find out more information again when they announce earnings. I think earnings could be pretty bad. But the cash flow projections for ExxonMobil are that they could lose $25 billion in negative cash flow. They just added a lot of debt to their balance sheet, long-term debt, in the last 5 or 6 weeks, and they've had multiple credit ratings downgrades already. I'm not predicting bankruptcy for ExxonMobil, but there could be a lot more pain. What these larger companies should do, and I don't think they will do it, or they're not going to do it right away, in my opinion, they should do, is start cutting the dividend, slashing the dividend, and conserving cash. They should not be adding a lot more long-term debt to the balance sheet, even if the CEOs and the chief financial officers at these companies run their calculations on Microsoft Excel spreadsheets, that they can borrow really cheap debt at only like 75 basis points above the federal funds rate. Just adding more and more debt to pay the dividend, probably not a good idea, because we don't know how long this oil bear market's going to go on for. Could go on for a couple months more before we get a bottom and then the economy restarts. Could be 6 months, could be 12, could be longer, we don't know. So adding lots and lots of more long-term debt to the balance sheet, probably not a good idea. Conserving cash, paying down debt, probably would be a better idea, but I'm not running these companies. So the CEOs at Chevron and ExxonMobil, I don't think they want their stocks crashing anymore. So I think they're going to do what they have to do to try to keep the dividend going. And that's a dangerous game in this environment with oil prices potentially falling. It looks like, look, the rules are being constantly changed for USO right now. USO is doing so many rules changes, it's tough to keep up with all of them. How many reverse stock splits have they done? How many different rules changes have they done to what parts, what duration oil futures contracts can they buy? It's just ridiculous. Meanwhile, all these millennials on Robinhood are buying this garbage. The amount of millennials on the Robinhood app that are buying USO is nuts. I've been warning people stay away from that. George Gammon, my friend, did an excellent video on USO showing that this thing has routinely lost money since it's been created. It's a wealth destruction vehicle. They can do a reverse stock split and it could crash again. And people are still going to buy it because that's their oil exposure. It's unbelievable. 20 minutes of research. All you have to do is 20 minutes of research on USO and figure out all the tracking data, tracking error problems, all the other problems with it. And people are not even doing that. They're gambling on the Robinhood app with USO. Welcome to dystopia. Just ridiculous. And we'll see if those millennials end up getting, if the Eagle plan goes into effect and they get their 10 grand. They pull their cash now. We'll see what they end up buying. Luke, excuse me, there's a question here in the live chat. Luke Townley says, are there many companies specializing in oil storage? Not a lot. You have the oil tanker companies. Those stocks are up a lot. People are going to be buying those. So the short-term trend is clearly higher. We're going to have to see Q1 earnings data to see how well the management teams are doing with those double lease rates. So the lease rates that have doubled for the tankers. The Saudis are sending tons and tons of oil here. And our refiners don't need Saudi oil. Our refiners do not need Arab Light oil. Our refiners actually need heavy sour crude. Again, if you think your dividend is safe with some of these oil companies, even if it's a pipeline company, I would urge extreme caution here. The probability is high of dividend cuts there too, and distributions for MLPs, distribution cuts there too. Why? Because we have so much oil production coming offline. Continental Resources and others are shutting down the oil production now. They're shutting in the wells, and these pipeline companies, the best way to think about a pipeline company is like a toll road. So if oil and natural gas, if it goes to a trickle or it shuts down, if it stops going through the pipeline, these pipeline companies don't make any money. So their cash flow can literally go from a lot of cash flow, from an oversupply, lots and lots of oil going through the pipeline, lots and lots of natural gas going through the pipeline. And now natural gas, from what I've been reading about Kinder Morgan and others, natural gas has fallen less on a percentage basis than oil. So Kinder Morgan's natural gas pipeline business is surprisingly doing better. But the amount of oil and natural gas, it can go from a lot of it going through a pipeline, like a toll road. So if you own a toll road, this is hypothetical. If you own a toll road and there's lots of cars and trucks and vans and motorcycles going through your toll road, right? You're collecting a lot of coins. It adds up. Well, the pipeline business is very, very similar. The more oil, the more natural gas that is piped through the pipeline, the more these pipeline companies get cash flow, the more they get to charge. The problems start, and this happened with Kinder Morgan in 2015, and why they cut the dividend, and there was other problems with their restructuring. I think they transitioned from a master limited partnership into a C corporation, but they cut their dividend, and a lot of it was because a lot of oil through their pipeline just stopped. So they cut their dividend. The share price of Kinder Morgan it crashed. If you go back and look on a chart, on October 5th, 2015, Kinder Morgan KMI was at $32.35 a share. By January 11th, 2016, it was at 13. And really, the share price has been in a pretty wide trading range since January 11th, 2016. It got as high as $22 on February 18th, 2020. But otherwise, it's been in a Kinder Morgan has been in a trading range, a wide one, since January 19th, 2016. So for over 4 years, Kinder Morgan has been in a very wide trading range. You have gotten basically no capital gains, and it's mostly an income investment. So if you want to say you don't care about capital gains in Kinder Morgan, that's fine. But Kinder Morgan has a 129.99% dividend payout ratio. I'm on Seeking Alpha, and you can click the dividend tab. You could do that for free. Their dividend yield is at 7.18. If that oil stops going through the pipeline, Kinder Morgan may have to cut the dividend. I'm not saying it's guaranteed. I'm saying there's a pretty high probability if enough oil production shuts down, they're going to lose a lot of their cash flows. I'll tell you what the USO should do. The USO should have been a physical oil storage ETF, not a papers, futures, contracts, and swaps and other paper garbage derivatives play. They should have physically built an oil storage facility, and it should have been contrarian, and they should be accumulating massive amounts of physical oil now for a private strategic petroleum reserve, and they should be storing oil and building more oil storage units, and then they could pay an insurance company, security guards. They can do this the right way. And then in the future, when oil prices are higher, you sell the oil. Not rocket science. Now, it would cost more money probably to set something like that up, and you have to have insurance because storing the physical barrels of oil, they're flammable, they're dangerous, they can be stolen. Pain in the ass transporting them, it's expensive. If you transport oil on a rail car, it's dangerous too. There's a lot of fires and explosions. It happened a number of years ago when the Bakken oil production was first being transported by rail car, and Warren Buffett was investing in those railroad companies. But that's how I would build an oil ETF, with physical oil, not with papers, futures, contracts. I think that would be the smart way to do it, but nowadays hardly anyone does anything smart or thinks long term anymore. Okay, super chat from JB. Thank you. He is also a Patreon account contributor, one of over 900 now. It's growing very, very rapidly. Thank you very much to George Gammon for helping me out there. You didn't have to. It was really nice. JB Weld. Okay, most land-based tank storage in the U.S. is held in Cushing, Oklahoma, in master limited partnerships. Make sense? The problem with master limited partnerships is tax problems. Someone was saying that K1, his accountant, filed it no problem. The accountants I've dealt with have had a lot of problems, and they're CPAs for 20 or 30 years. But then again, I live in an expensive metro area where I've asked a bunch of different accountants for figures to do my taxes, and the cheapest one was like $700 a year. And then one guy on the phone told me he doesn't even get bothered unless it's like he was at a larger accounting firm. He was a CPA. He said it was like 10 or 20 grand. The accountants around here are as bad or worse than doctors and lawyers for overcharging. The lawyers here are horrible for overcharging in this area. Okay, another super chat from JB. If you look for master limited partnerships, a pure play take or pay storage company is the flavor of the company I would look at. Again, but the problem is, JB, that you can't trade these things. You're going to get really bad tax consequences. If you buy these things and then you hold them for a couple months, and you try to play the super contango and you do make a profit, you're not going to lock in a long-term capital gains tax like you would buying and holding a stock for a year. That's the problem. So you're not going to lock in that long-term capital gains tax. So you might have paper trading profits, but then your tax consequences bill is going to be a lot worse than buying and holding a regular stock, which is a C corporation. Super chat from Mike Sutherland. Is it worth opening a futures account with CME and purchasing a June-July contract in hopes of buying at WTI lows, or is that too dangerous? It is definitely too dangerous. It is definitely too dangerous. You would be unhedged. In my opinion, the investment bankers would see your order book, so they would see exactly how much margin you have. So if you paid all cash for the futures contract, this is hypothetical. In my opinion, if you paid all cash for the futures contract, you might be okay. But if you took it out on margin, the investment banks get to see your order book. They get to see exactly, this is how unfair the futures market is. They get to see exactly how much margin you took out. And they can program it into their trading algorithms. And Eric Townsend has talked about this a lot too from Macro Voices. They just blow out stops all day long. So they move the price with their algorithms now, up, down, up, down, up, down, up, down. That's why the trading range for this oil market was so much, because the little guys, that's why the day's trading range today was from $12.82 to, the market just reopened. What does it say here on the screen? Okay, it was $11.88 to $16.98. The new futures market just opened again. That's why. So the futures market a few hours ago after it closed, the range was from $11.88 to $16.98. There was a lot of movement there with high-frequency trading algorithms. They can blow out the little guy easily. The little guy does not understand this. He sees that oil is cheap and that he's going to take the risk there, but he doesn't see how tilted the playing field is with the investment banks. They can literally see exactly how much margin you have, and they can blow you out in an hour or two and make it so you owe a lot more money than you risked. The game is rigged in the futures market for the little guy. So I would not play there. If you're a volatility trader with options, maybe, in my opinion, you could hedge with some puts and calls. I'm not picking a direction right now. If I had a bet, in my opinion, on a direction, I think we're still going lower because I don't see any signs demand is recovering. There are no signs anywhere yet that demand is recovering. My friend Jeffrey Landsberg at Commodore Research, the Chinese traffic data he tracks, and he sends me daily emails Monday through Friday. Only the rush hour traffic is anywhere close to 2019 levels. All the other traffic data in all the other major Chinese cities is horrible. India is still in lockdown for at least another 10 days. There's hardly gasoline demand. The last statistic I saw for gasoline demand in the U.S. is still down 48% over the last year. The European Union, a lot of it's on lockdown. There's no signs demand is rebounding. So until that happens, yes, there are a lot of oil producers shutting production. Yes, Continental Resources did shut in their wells, but there was so much oversupply that they were using pipelines for storage now. So if you're making a lot off master limited partnerships and you can afford the higher tax bill, then okay. But the average person, the tax bill is going to be more than the gains they make. If you have a lot of MLP units and you put on a big trade and you can afford the extra tax bill, okay, maybe the trade-off there, the cost benefit for the extra tax bill is not as bad. But the average retail person, they're going to put on that trade, they're going to screw up, and then they're going to get stuck with a big tax bill if they get some gains. It's really sad. But the futures market, in general, the futures market just preys on the little guy. So, Mike, I would avoid the futures market. Definitely avoid USO. I would not be surprised after this reverse stock split if in a couple months from now USO has crashed again. Let me see if USO, how it is. I haven't looked at it in the last couple days. Let's see how the USO reverse stock split's doing. And the USO is down 15% today. Just under 15%. What a poorly designed product. That thing is designed to lose money. Okay, so I think that's it for the update for this show. Again, do not count, in my opinion, do not count on income investments from the oil market right now. That's the problem, because we don't know when demand is going to rebound. Until demand rebounds, the price could go lower and lower and lower. Yes, it's good that supply is being cut. Yes, it's good that the rig count's coming down, although it was way too high. The rig count's still too high. It's good it's coming down, but it was way too high. The rig count's coming down like 50, 60, 70 rigs per week now. So that's good. It should have happened a while ago, though. What the larger oil companies should do, again, in my opinion, is they should cut the dividend and they should conserve cash, but I don't think that's going to happen. Okay, I want to thank everyone for listening. Thank you very much to my over 900 Patreon account contributors. It is growing very rapidly every day now. It's amazing. I work very, very hard, not a lot of sleep, to provide a lot of value with a lot of research information, financial education, and analysis behind the paywall. I only charge $5 a month. It's a bad cup of coffee. We'll see if anyone else can touch that. There are newsletters that charge $500 a year that aren't anything close to what I offer beyond the paywall. There's a lot of good calls in there too. 2 months ago, people were warned that Whiting Petroleum was going to go bankrupt and that Diamond Offshore Drilling was going to go bankrupt. And guess what? Diamond Offshore Drilling declared bankruptcy yesterday. That's in comparison to certain Seeking Alpha article writers that were saying that Diamond Offshore Drilling had a perfectly clean balance sheet only a week ago. It was very predictable. I'm not an oracle. I just read the SEC filings for Diamond Offshore Drilling. They disclosed immense problems in early February. They disclosed in early February in their annual report, CEO comments, that they would be cash flow negative for all of 2020 before oil prices crashed. So once oil prices crashed, it was even worse. And they already had debt on the balance sheet. They had a clear cash flow problem. You already have debt on the balance sheet. You have a clear cash flow problem. And in early February, the CEO is talking about using even more debt on a revolving credit facility. You know the time's ticking for bankruptcy then. I got a super chat from Cam Mills. Thank you for the super chat. Before I wrap things up, what are your thoughts on pure play natural gas companies now that Permian Associative Gas is shut in? I actually haven't looked at natural gas in a while. Let me take a look at the chart for natural gas. Natural gas is actually up today, believe it or not. Let me see here. Natural gas is starting to put in some bottoms here. Not bad on the chart. I have the 1 month chart open. Natural gas on April 2nd trying to put in a bottom. On April 15th trying to put in a bottom. Looks like a little higher lows here. Not bad. The chart is improving on the natural gas price chart. I'm not sure if I'd buy any yet. I really want to see more bankruptcies first. I think it's still too early. We need to see like Chesapeake go bankrupt, some of the other companies go bankrupt. We need to see more mergers and acquisitions. I would wait. I still think everything's a falling knife, but the natural gas chart actually does look good. It's looking good. It's had two nice little bounces here. Off $1.55 and $1.59. About $1.60. It's had two nice little bounces there. Is that the bottom? I don't know. But it looks like it's trying to put in a bottom. Okay, question here from Pudenda. How do you become a Patreon member? Good question. The link is actually below every single video or interview. It's in the information and description section. It's patreon.com/ and then the company name. I think it's WALLSTFORMEINST. There's a lot of research, a lot of articles, audio podcasts, technical analysis charts behind the paywall. I try to put one or two pieces of research out per week. Sometimes it's more, sometimes it's less. Yeah, so I'm not really into accumulating natural gas yet. I haven't looked at a lot of the companies. I haven't looked at Devon in a while. Devon was actually... Let's see, Devon. I haven't looked at Devon in a long time. Oh, Devon crashed. Devon has no earnings per share now, negative. Devon used to be a pretty well-run company. That's interesting. There's a lot of Seeking Alpha article writers that think Devon's in pretty good shape now. Interesting. Devon used to be one of the quality natural gas producers. I remember they used to have like $5 or $6 earnings per share. Let me see when their earnings announcements is. Let's see. Okay, Devon announces earnings on May 5th. So that's maybe a company I could take a look at behind the paywall. So we'll see what the earnings data comes out with. That might be a company that I'll write an article on, along with maybe some of the oil tanker stocks after we get more Q1 earnings data. Maybe I'll do a write-up on Devon Energy, DVN. Normally, they're considered one of the safer natural gas plays. That might be a company I'll have to do more research on. Okay, everyone. Thank you for listening. Thank you very much to my Patreon account contributors, my monthly PayPal contributors, and people throw me a tip once in a while. The website is back online. I haven't gotten the email capture working yet. I am working with tech support. The email's back, though. Not the email. Excuse me. The website's back. I got the website back up. So I did that over the weekend a couple days ago. Tech support helped me get it back up. I am working on other things. It's just me here, though, so there's a lot of work for just me to do. So the email capture on the website's not working yet. I will hopefully in the next week or so get that done. I have to actually hop off this live stream show and email tech support again. Okay, everyone. Bye for now. Have a nice week.